Hey folks, and welcome back to another San Diego County real estate market update. I'm Jed Bratt, and in this video, we're looking at the numbers for November 2019. We're going to look at the year-over-year numbers and other impacting factors to the real estate market here in San Diego. And then we're also going to talk a little bit about the concerns that I have with the California and San Diego County real estate market as we currently sit. So we're going to get to that in the end of the video. And if you haven't already, be sure to subscribe so you are the first to get notifications about these videos. And we also put out other great videos on other content, and we're going to only continue to do more so of that in the near future. So be sure to subscribe, and let's go ahead and dive in. So we are looking at San Diego County, detached townhomes, twin homes, row homes, all of them attached, so all the bread and butter units here. At the end of October, we were down 23.7% year over year in San Diego County for inventory of active listings that buyers have to pick from. New listings, we were down 12.2%. As I've described in past market reports, new listings is simply properties that are fresh on the market. They're not being renewed. They didn't expire their first time on the market for this round of trying to sell it. So new listings going hand in hand with active listings. You can see there is a major decrease in overall inventory still. Pending sales continuing this trend, 18% increase year over year. So more properties are going on the market, fewer properties are coming on, and this is going to result in more sold listings as well. So just under 5% year over year increase in sold listings. So all of these indicators are essentially just saying yes. The same trend that has been going on is going to continue, or is continuing rather, in that available inventory is shrinking. Nothing new there. 5.2% year over year increase in the median sales price across the county. Not a drastic increase. This is just a small data point. We're really not too far off from where we were just about a year ago. If we were to make this 3 months, this number should probably be a little bit less, 1.7%. If we're looking at the rolling 6 months, 1.7%, rolling 12 months, 2.2%. And now, of course, some of that is some of what's factored into those rolling numbers is the slowdown at the end of last year, as interest rates are going higher and there was some kind of funky stuff going on in the market. But nonetheless, we are still continuing to go positive in appreciation figures, but nothing crazy like we've seen in the past. Now, if we look at, let's just look at economic indicators. San Diego metropolitan area, payrolls and employment has been increasing, as would be a healthy sign of an economic movement. Non-farm jobs and other payrolls have been up, which is good. We're, as we know, some of the lowest unemployment rates in history, and San Diego is some of the lowest in the nation. National economy at a glance, 1.9% GDP growth, third quarter 2019. So it's a little bit under what their target is. Their target's typically 2 to 3%, but at the same time, that's not too far off from where that is. But what's been going on with everything? Because if we look at the macro scale, everything in the economy looks extremely healthy. The Fed still nonetheless dropped Fed funds rate target for the third consecutive time in just the other month. Okay, so now the effective funds rate is sitting at around 1.83%, but right now the target's 1.5 to 1.75. I've talked about this a number of times in other videos. You can take a look at those. The Fed funds rate target does not directly correlate to mortgage interest rates, as we brought up every single time we talk about this, but nonetheless, it is an indicator that we want to keep an eye on, because it dictates fiscal policy as far as how the Fed is trying to, or is perceiving the current state of the market, the U.S. economy. And recession or no recession doesn't always directly tie into whether or not there's any major changes going on with the real estate market. They can act completely independently, but nonetheless, interest rates, as far as the Fed funds rate, this affects the short-term rates. And short-term rates aren't always directly tied to Long-term rates, of course, not always. They aren't the same. They are different products, but nonetheless, it is availability of money. And of course, it's going to be nearly impossible to have incredibly high mortgage interest rates if the Fed funds rate is effectively very, very low, and vice versa. So it is something to keep in your focal point as things change, and it also is a direct reflecting indicator of, like I said, what the Fed is considering is going on with the economy. So we've talked about this before. There was some slowing in the global market. There's a lot of funky things going on. We're coming on a new election year. So there is a lot of uncertainty in the air as far as where we're going to be come the end of next year. Who's going to be the president? Who is, what's going to be the result or the status of this global trade war that we're seeing between the U.S. and China. There's a lot of uncertainty that's not just reflected in the markets, but in the global economy as a whole, not just in the stock market in the U.S. here. So there's a lot of things to keep in mind, but nonetheless, all the indicators still for the economy seem to be plugging along just fine. 30-year fixed rate mortgage averages in the U.S. If we look at the most recent data point here, November 14th, and this is nationwide, just average for 30-year fixed. So this includes, conventional FHA, VA. This is just a metric I like to compare periodically to, just to see where we are compared to where we were a few months back or a few years back. 3.75, amazing rate. If you really wanted to shop around for a great rate right now, though, depending on the loan product, you might be able to find some incredible rates starting with a 2. And we've had videos in the past about 2% interest rates. Go ahead and check those out if you'd like. But 3.75 as the average, we got a couple clients right now, and I've heard other stories of people locking in 2.75, 2.875 for VA. 30-year fixed. That's just incredible. And I also have some videos that compare, like a 2% interest rate versus a 3% interest rate, and the massive difference that makes in just 5-10 years of holding onto your mortgage. And the principal pay down, not just in your monthly payment, but in the overall principal pay down and equity buildup. So a lot of exciting opportunities there. Should you look for an opportunity to refinance, I encourage you to explore that. And if you'd like some recommendations on different lenders who can get you the lowest rate, feel free to reach out to me. Now, I'm just going to touch on the yield curve. This was the focal point of news stories over the past few months when it inverted the 10-year to the 2-year. It only inverted for a quick moment. Historically speaking, that always happens, or at least it has happened prior to the last 7 recessions. Just because it's reverse course and gone up again doesn't really mean, everything's fine and dandy. And this isn't really an end-all be-all. Like when it does this, it doesn't... People can't say for 100% certainty why exactly this happens right before a recession, but it consistently does, because it's also a reflector of the sentiment of investors out there and those people buying bonds. And many times in the past, it's gone down and then it's come back up again before it hits a recession. Gone back down, gone up, come back down again. So yeah, for whatever that's worth, this is just more of a past historically, it's a historic phenomenon that pretty much happens. And for whatever it's worth for you to take a look at it there. We've talked about this in other videos as well. But it's gone, there's the 10-year is still yielding higher than the 2-year right now. So it's gone back from its inverse point, but nonetheless, be interesting to see how that plays out in the future, given the uncertainty in the bigger picture of the national economy going forward. So, like I said, everything in general, in the big picture, seems to be going along healthily in California real estate, because that's ultimately what we're talking about here. In San Diego, everything seems to be plugging along just fine. Appreciation is a little bit slower than it's been in the past because, of course, fewer and fewer people can afford to buy homes, the more expensive they get, and therefore that's going to put a little bit of a lag on how quickly properties move. Now, that said, and actually let me wrap up on a few things here. I'll just also throw in average active market time just for reference. In San Diego County, down 3% year over year. We talked about this slowdown previously in other videos at the end of last year. Months of inventory down almost 20% year over year. So again, just factors showing that there is definitely a lack of inventory, and that's only getting smaller and smaller. Once again, it's continuing the trend that was going on up until mid last year. So that said, what concerns me about the California market? Well, if you watch any of the recent videos I've done, for example, the one on AB 1482, the California Tenant Protection Act, or California rent control, if you just want to say it bluntly, what concerns me about things like that is that Prop 10 that was proposed last year went to the polls, and 59% of California voters voted against it. The California people voted against this rent control measure. And yet, what happened? At the beginning of this year, California legislature took it upon themselves to go ahead and say, hey, we don't care that this measure that was proposed, it got the qualifying votes. It went on the ballot. The California people voted, and they voted it down. They don't care. They said, you know what? Let's go ahead and pass this sweeping legislation that will drastically control the way you are allowed to use your real estate that you own. And they made it retroactive as well, back to March 15th at the beginning of the year. So people couldn't even be like, oh, well, this is going to change, so I'm going to make some last minute changes. No, they actually worked that in there. So they would circumvent anybody trying to do that. And it's, at the very least, it's a bit concerning when you think about, well, you do your research, you look at the properties and the markets that you want to buy, you run the numbers, and you make sure that everything makes sense. You run the math. Then you put down your hard-earned, already taxed money to purchase this asset and hope for the returns and look forward to operating it the way you planned in your investment projections. And then they come in and then they make these laws retroactively against the will of the California people that completely alter that. That said, that's done, okay? So you're like, okay, well, Jed, that only affects anything new construction. That's not, new construction shouldn't be deterred too much because there's an exemption for anything built in the last 15 years, and it doesn't apply to duplexes if you live in one of the units. Yeah, sure, but it applies to a whole lot of other things. If you don't live in one of the two units, a duplex is not exempt. 3 and 4 units are not exempt. There's a tremendous amount of control that was just taken away from not only the big, but very small investors as well in California. So that's concerning to me. Secondarily, that's just the first wave, okay? So there is a lot of pressure going on. There are several initiatives such as this, which, again, kind of fell off the cliff last year and in previous years, people trying to repeal Prop 13. Now, Prop 13, I think we've done some videos in the past that touch on this topic, but essentially Prop 13 was passed in the 70s, and it put a cap not only on the base amount that you can be charged for your property taxes, but also on the assessed value that will annually increase. So it puts a cap of 2% year-over-year increase on the assessed value of your property. Typically speaking, the assessed value is calculated as the sales price when a property sells. Doesn't have to be, but I'd say about 99% of the time that is what it ends up being. And this includes commercial properties. It includes single-family residential condos. It includes properties in California, any property in California. Okay. And this is a huge boon to investors and homeowners. And the reason this was passed in the first place was because there were people on fixed incomes and other scenarios that were just being beat up when property prices were appreciating double digits year over year, and the county was coming in and reassessing them, saying, "Oh, your property was worth $150,000 last year. Well, this year it's $220,000, and now you're paying taxes on that." And it was absolutely decimating some households, especially people on fixed income. So they finally passed this sweeping bill that we don't need in most other states because we don't have that same appreciation I wouldn't say problem, but that the appreciation is usually not as aggressive as it is in California, historically speaking. So this is a very unique bill, but it's also very important for Californians because it protects a lot of people in many different environments. And there is strong efforts right now to repeal Prop 13. Now, you'll probably say, okay, well, they're not trying to repeal it entirely. They're just trying to repeal portions of Prop 13, which is somewhat correct. They're trying to apply it to they're trying to repeal the portion that applies to commercial properties. But if what I'm being told from different sources is also correct, and I haven't been able to confirm this quite yet online, but if what I hear is correct, they're also working to redefine commercial as anything including 2 to 4 units for the sake of this repeal. And things like this, folks, it's just worrisome, because let's just say this goes on the ballot and it gets turned down. Let's just say homeowners vote against this, because understandably so, if you think about it, homeowners are protected by this. So if they're going to vote for this, they're essentially shooting themselves in the foot potentially. But let's just say it does. So let's just say it doesn't pass. Well, there is nothing to say that the California legislature come early next year will say, well, we don't care that the California people voted against this, and we're going to go ahead and take matters into our own hands and completely overturn this protection in the past, so that we can gather more money to apply towards our budget that we carelessly spend and misuse and always need assistance from federal government for, and it's just, to be honest with you, I mean, it's just worrisome if nothing else, because it just demonstrates that the legislature is potentially willing to go directly against the will of the California voter. And things like this could drastically change not only the value of your property, but the income you depend on, or the low expenses you depend on to keep a property profitable and continuing to operate it. So that said, that's one of the things that concerns me. And you might say, okay, well that's not going to crash the market or anything, because we still have far excessive demand for housing than we do supply. And if you realize, and I've talked about this in the past, California is net negative in migration for over a decade. The godsend, the saving grace of our population not going backwards, sliding down the hill, is immigration. So net migration is negative. That means there are more people domestically moving out of the state than into this state from other states. And what keeps us afloat population-wise is immigration. And granted, a lot of those people are coming in with a lot of money, and that's what helps to drive up prices in California. But what happens when there is more uncertainty in the air than anything else, and things like these bills, potential repeal of Prop 13 or AB 1482 come into play? Is this going to encourage people to come in and invest here and dump their hard-earned money here? Or is it going to continue the trend of people moving out of California? And I don't think this is going to be something that happens every night, but nonetheless, this is what to me is more worrisome than anything. And I don't see really anybody else talking about this specifically, but this is my concern if I'm deciding where to put my money. So AB 1482 already made me think twice. Even though it doesn't directly affect the majority of the types of properties I would invest in California, it certainly made me stop for a second and think, if they're going to do this, what else are they going to do? So anyway, this is a topic to be continued. It's just more of a what if based on the people that are currently in office in California and whose interests they have in mind. And what measures they're willing to go to get what they want or campaign on. So anyway, folks, that's a wrap for right now. We will have videos on this in the future. And if you found value in this, please hit the like button, subscribe, and share with anybody else who you think might find value in this. And I look forward to seeing you in the next video. As always, thank you for watching.